Hello. So today we're going to have a look at the topic of the balance of payments. Now, a lot of students fail to get excited about the balance of payments, but I think this is really the nub of macroeconomics. I mean, if we have a good balance of payments position, that really tells you something about the economy and the prosperity of the society and where that country is going. So we're really getting to the heart of, the fate and wealth of nations. Hopefully, I can impart some of that enthusiasm this afternoon and make this topic make sense. So, let's begin with what is the balance of payments? Well, a balance of payments means that the revenue from selling goods and services abroad equals expenditure on imports of goods and services. In other words, X equals M. But the balance of payments is an official record. It's a set of accounts. And it's just looking at the money flowing in and out of an economy over time. And in the UK, we've been gathering those statistics since 1687. As an official record, the balance of payments is broken down into two accounts: the current account and the capital and financial account, often just referred to as the capital account. Okay, so let's begin by having a look at the current account. So the current account itself is broken up into four main areas. The first is trade in goods, sometimes called visibles or tangibles, things you can pick up, touch, feel, exist, basically. So these can be finished goods that we would consume as consumers, semi-finished goods, so things we might be importing and exporting to go into something else, like microchips, something like that. Commodities, your raw materials such as oil, tea, coffee, copper, that sort of thing. Then the second account in the current account is trade in services. We do a lot of exporting of services in the UK. Could be tourism, consultancy, financial services, insurance, all that sort of thing. Number three is investment income. So this includes overseas profits. So if a UK company has a subsidiary in a foreign country, the profits it makes are repatriated to the UK, and that would be investment income coming into the UK. Toyota, a Japanese company that operates up in Sunderland, the profits from that factory will go back to Japan, and that would be an outflow of investment income from the UK to Japan. Interest received from UK financial investments abroad, dividends from owning shares in foreign companies. And finally, we have financial transfers. So this could be gifts, remittances of people working in the UK and sending money back home, charitable donations across borders, overseas aid, military aid. Anytime we're transferring money and not expecting anything in return. So let's have a look at the current account for 2023. So in 2023, the UK was running a current account deficit of £18 billion. I've got a simplified version of it here. So goods, we're exporting £227 billion worth of goods, which is pretty good. But we've got a large appetite for the imports of goods, 310 billion. So we're running a deficit on the first part of the current account. Services, we're doing better here. So we export £158 billion worth of services, banking, consultancy, insurance, architecture, all that sort of thing. And we're importing £109 billion. So we're running a surplus on services. We've also got a surplus on our net investment income from abroad. So we've got £173 billion coming into the UK from investment income and 143 billion leaving, giving us a balance of plus 30 billion. Transfers, as you might expect, we send more money overseas, 31 billion, than is sent here, 16 billion. So we run a deficit on this part of the current account of minus 14 billion, giving us an overall total of minus 18 billion. You can see our biggest deficit, or biggest debit, which contributes to the deficit, is our debits in goods. And our major imports, when you look into the Office for National Statistics, is electrical machinery, cars and other transport equipment, mechanical machinery, clothing, as you'd expect, and petrol. So now let's have a look at the capital and financial account. So this account measures the flows of capital and finance. So here we've got things like foreign direct investment, FDI, such as UK firms setting up manufacturing plants in South Africa, for example. Portfolio investments, such as UK citizens buying shares in an overseas firm in anticipation of some long-term return. Short-term speculative flows, sometimes called hot money, where speculators invest abroad to seek out the highest short-term return for their investment. 4, official financing, which occurs when a central bank buys or sells currencies, securities, and other assets to create an inflow or outflow in the accounts. In an accounting sense, the Bank of England must ensure that all the accounts balance. So let's have a quick look at that official financing, which is known as the balancing item. So gathering accurate data is a huge challenge, and it is impossible without a device called the balancing item. We saw on a previous slide that we're talking about billions of pounds worth of stuff coming in and out. So there are inevitable errors in data collection, as well as things that are just missed, omissions. So to allow for these, the government statisticians employ what we call the balancing item, which can be defined as the device used to compensate for errors and omissions in the balance of payments data, and which brings the final balance of payments account to zero, because as the name suggests, balance of payments, the accounts have to balance. So we're running a deficit on the current account. We know that. Is this a problem? Well, let's have a look. A deficit is a problem if it is persistent, if it's carrying on over a long period of time. If it forms a large share of GDP, yep, it can be a problem. Are there no compensating flows? So what's happening on the capital account, for example? The economy has low reserves. This may make it difficult for us to finance a deficit in the long run. If the economy has a poor record on repaying its debt, that could get us into difficulties as well. So let's have a look at some of these in a bit more detail and have a look at economic growth and trade performance. Now, there is a strong connection between a growing economy and a trade deficit. The strong inverse connection between a growing economy and a trade deficit can be seen in this graph, which I'm about to show you now. So, okay, so we've got 1986 to 2010. Now, I know that's a long time ago, but I like this data because it really highlights this inverse relationship. It's true right up to the present day, but you can really see it in this data here. So there is 0, and let's plot growth. Okay, so we've got economic growth as a percentage. So you can see just before 1989, we're growing about 5.5%. leading into a recession. Let's sort of point that out down here. Really lovely economic growth between sort of 1992 and early 2000s, and of course the 2008 financial crisis. Okay, let's get ready for some more brilliant animation. So we've got the zero here for the trade balance. And here we go. So first thing to note is that trade in goods and services for the UK is almost always in deficit. But what you should be able to see is that when the economy is growing relatively strongly, it's in a bigger deficit. And the reason is quite simple. The stronger we're growing as an economy, the richer we're getting. And then if we're getting richer, we're buying more stuff. And some of that stuff will naturally just come from abroad. So what we say is we're sucking in imports from abroad when we're getting richer. When we're in a recession, we're getting poorer and we're buying less stuff. So we're sucking in less imports from abroad. So we can have a look here. Economic growth above the trend rate accelerates the worsening of the trade balance. And we've got some bits I can highlight here. So 2.5 is traditionally the UK's trend rate of economic growth. And you can see when our green growth line is above that trend or on that trend, we have worsening trade in goods and services. So we've got above trend rate there. And here we go. Worsening deficit. Yep. So hopefully we can see that. That is real world data showing or proving economic theory. Proud of that. Right, okay. What are the causes of the current account deficit? Well, there are a number of possible causes of a persistent current account deficit, and these are follows. Excess growth. We've seen that on the previous slide. So, if the economy grows too weakly and rises above, not weakly, sorry, quickly, and rises above the trend rate for an economy, which in the UK is around 2.5%, then domestic output, AS, cannot cope with domestic demand, AD, and we import. Higher export prices, which could occur if inflation is higher than in other countries. So if we've got high inflation in the UK compared to other countries, our stuff's getting more expensive and they don't want to buy it from us. Non-price factors, which can discourage exports, badly designed products, poor marketing, or a worsening reputation for reliability. We're not too bad in the UK now, actually. A little badge saying made in Britain is a sign usually of good quality, but it wasn't always that. 1970s, 1980s, people associated British made goods with poor quality and poor craftsmanship. Further causes, poor productivity. So an economy might not be producing enough from its scarce factors of production. Labour productivity plays an important role in a country's competitiveness and trade performance. We could have low levels of investment in real capital, and this is a particular problem for the UK economy. So this could be caused by excessive long-term interest rates, low levels of research and development. Number 6 could be low levels of investment in human capital. That's me and you, education, training, that sort of thing. So this involves a lack of investment in education and training, which reduces skill levels relative to competitor countries and forces countries to produce low value exports. Okay, so we've got a current account deficit. What are we going to do about it? Let's find out. So there are 4 basic strategies for dealing with a persistent deficit. The first is deflating demand. So deflating demand means deliberately reducing consumer spending or reducing its rate of growth through tighter fiscal or monetary policy. Remember I said a problem is when we're all getting richer, we spend more, and some of the things we buy, we're pulling in from abroad, worsening our deficit. So we could just make everybody poorer and reduce their consumer spending. This is, as you can imagine, extremely unpopular, and only done in extreme cases. So, as a byproduct of this, imports are likely to fall. Hence, deflating demand is said to work by expenditure reduction. This policy targets general spending, and if imports are dependent on spending, then imports will fall as spending falls. But remember, spending is going to fall on everything. So this can be quite damaging. The connection between spending and imports is called the marginal propensity to import, which is expressed as this: the percentage change in imports, M, divided by the percentage change in national income, Y. Let's carry on having a look at expenditure reducing policies. So, evaluation. The main criticism of deflationary policy is that, as spending power must fall, personal incomes and standard of living will also fall, and this can trigger demand-efficient unemployment. For the above reason, deflation is politically unpopular. Voters are much more likely to be concerned with recession and unemployment than a balance of payments deficit. Like I said, apart from a little blip in the 1990s, we've run a deficit since about 1986. Doesn't keep me up at night too much. I'm sure it doesn't to you guys either. It is also difficult to predict the precise effect of this policy. This requires an accurate calculation of the marginal propensity to import. Devaluation. So this means deliberately reducing the value of a country's currency, and it works by what we call expenditure switching. So remember, deflation would be expenditure reducing. Now we're trying to switch people's expenditure. So fall in the exchange rate will reduce export prices, causing overseas customers to switch to UK products, hence leading to a rise in export demand. It will also lead to an increase in import prices, causing UK consumers to switch away from imports to domestically produced products. And this will lead to a fall in import demand. Evaluation of this one. Devaluation relies on the assumption that the sum of the price of elasticities of demand for imports and exports is elastic. In other words, greater than 1. That's a bit of a mouthful. So this is known as the Marshall-Lerner condition. However, this may not be satisfied in the short run or even the long run. Marshall-Lerner condition is really important, and we'll have a look at that. Devaluation may also trigger cost-push inflation. A fall in the value of the currency will increase the price of imported goods in terms of the domestic currency. Devaluation may be interpreted as a hostile move against other countries and may lead to retaliation by competitors, so that no long-term benefits are derived from the devaluation because they're cancelled out by other countries devaluing in retaliation. So, I said the Marshall-Lerner condition. I said we'll explain that. Here it is. So to understand the effects of a devaluation, it is necessary to reconsider price elasticity of demand, everybody's favorite from year one microeconomics. So the Marshall-Lerner condition. Remember we said that a devaluation will only work if the price elasticity of demand of imports and exports is greater than 1. Well, let's have a look. Demand for imports and demand for exports on the screen now. So you can see that I've got a steep demand curve, which is inelastic, and a shallow demand curve, which is elastic. And devaluation rises import prices. So import spending before devaluation is the green shaded area there. We devalue, we increase the price, and look at the yellow area now. New import spending when demand for imports is inelastic. And look, when it's elastic. New import spending when demand for imports is elastic. So our devaluation has really helped us reduce imports, but only if it's elastic. Now, we're hoping our devaluation will lead to more value of exports. So devaluation reduces export prices. Here we go. And you can see that new export revenue, if export demand is inelastic, hasn't helped. But if it's elastic, it's helped. So clearly, the optimal situation is to devalue when price elasticity of demand for both imports and exports is elastic. Import spending falls and export revenue rises. Happy days. The J curve. We've got lovely diagrams in this topic. So the J curve. Now, assuming the Marshall-Lerner condition is satisfied, devaluation will improve the balance of payments. Excellent. It solved the problem without making us all poorer like expenditure reduction policies do. But if it is not satisfied, devaluation will worsen the balance of payments. Okay, we've got some more lovely animations here. Right, so let's have a look at 2008. As you can see here, we've got time on the x-axis and the balance payments on the y-axis. If it's above the timeline, it's surplus. If it's below, it's in a deficit. And we can plot what happens after a devaluation. So a J-curve effect will exist when the Marshall-Lerner condition is met in the long run, but not in the short run. And you can see it looks a bit like a J. Yep. So we devalue, and because people are stuck in contracts and that sort of thing, the price elasticity of demand for imports and exports is inelastic. So it drives us further into deficit. But over time, as people realize what's going on, they get out of contracts, they switch their expenditure, we move into surplus. So if PED of imports is elastic, then the fall in the demand for imports is proportionately greater than the price rise. Import spending will fall. If PED for exports is elastic, the fall in export prices is proportionately less than the rise in export revenue. So the net effect is an improvement in the balance of trade. And then we could have direct controls, number 3. So a third option is to help reduce the current account deficit by imposing direct controls on imports, such as erecting barriers against imports or providing assistance to exporters. So it could be tariffs or non-tariff barriers, such as quotas, subsidies to domestic firms, discrimination against imports in favour of domestic firms. All these things could be used. Evaluation of this. Well, in the short run, trade barriers may help to reduce imports and help improve the current account. However, retaliation is a likely response, and any short-term gains will be eroded away. So direct controls are not an effective long-term solution to a current account deficit. And then we come on to the supply side of things. Supply side policy for number 4. Finally, supply side policy could be used to help improve an economy's ability to produce. There are a number of specific individual actions that a government could take to improve supply side performance, including measures to improve labour productivity and labour market flexibility. The evaluation of this. Well, supply-side policies can provide a highly effective policy framework for long-term improvements in competitiveness and current account performance. The major problem is that supply-side policies take decades to work. What we say in economics is they have a long time lag, and this is not a quick fix if you're in the middle of a current account crisis.